Howdy, y'all. Welcome to Everybody Call. Today is Wednesday, September 20th, 2023. Hope everybody's having a fantastical day out there in the interwebs. Interesting day here at DSA Financial Group's world headquarters. We had a bear sighting. So, within an hour after Chairman Powell had finished up his little, talking and everything and announced that they weren't raising rates, a bear walked right across. So we'll go ahead and let's go to the footage. So I don't know if this is, here's Mr. Bear right here. You see him? And, to preface this, let me step back. My wife had been out with lunch with some of her colleagues, and she'd called and said, hey, why don't you open up the front or the garage? I need to run in so I'm not running late for my meeting. So I went and opened the garage, came back, sat down here at my desk, and then ding, a little thing popped up on my phone. I'm thinking, it's a turkey or a deer walking by. Wrong. It was a bear. So let's go ahead and go to the footage. So you can see him. He's walking down the little side drive we have here along the side of the house. He comes moseying on in and decides to walk into my garage. So about this point is when I'm getting the alert on my phone and go scrambling to the garage door and then run to the kitchen to get some pots and pans. And let's see, let's speed this up a little bit. See him coming out. Should be any second now. And you can hear me smacking the pots. There he goes. Here, bye, Mr. Bear. And then he walks down the driveway and then through the bushes and over to someone else's house. So, and you see me coming out here in a minute. There I am. Anyways, exciting stuff, folks. So, alrighty. So now that we got the bear news out of the way. So again, I don't know if that's a harbinger of good or bad news that, the bear market may make an appearance sooner than later, but who knows? All right, let's go ahead and jump into the numbers for today and see how they turned out. Market didn't react very well after Chairman Powell's meeting. So the Dow Jones finished the day down 0.22%, 76 points, closed at 3440. S&P 500 closed down 0.94%, closed at 4402. NASDAQ was down 1.53%, closed at 13,469. The VIX was up 6.73% today. It's at 1507. Canada was flat, down 0.02. Brazil was up 0.84, and Mexico was up 0.51%. Over in Europe, Germany was up 0.75%. The UK was up 0.93. France was up 0.67. Netherlands up 0.46. Spain up 1.24. Italy up 1.64. Switzerland up 0.77. And Portugal up 0.55. Russian exchanges both red today. MOEX down 0.51. RTSI down 0.08. And nothing but red across the Asian markets. The Nikkei in Japan was down 0.73, Australia down 0.46, New Zealand down 0.74. In China, the Shanghai was down 0.52%, Shenzhen Component down 0.53%, and the Astros just lined out. They're still losing 1-0 into the sixth. China A50 down 0.36, DJ Shanghai down 0.55, Hang Seng down 0.49%, and the Taiwan weighted down 0.69%. So yeah, not excellent out there today, and I'm not really sure what's spooking the market. Was it that you would have thought that folks would have been really thrilled that they didn't raise rates, which, in my opinion was kind of 50-50, but a lot of prognosticators out there are like, we're for certain not going to raise any more rates. We're at the peak and we're probably going to start lowering rates in the future. Well, we'll see if that actually occurs. All right, let's get to the market recap. S&P 500 slip says Treasury yields rebound after Fed delivered hawkish pause. The S&P 500 experienced a decline on Wednesday, reversing intraday gains due to a surge in Treasury yields that impacted growth sectors, especially the tech sector. This shift followed the Federal Reserve's decision to maintain interest rates at their current level while indicating a commitment to a prolonged period of higher interest rates. I don't know if I'd really consider 5.25 to 5.5 high, but, maybe for the last 20 years. The Federal Reserve's decision to leave interest rates unchanged came with a signal of higher for longer rate approach. Although the central bank kept its forecast for one more rate hike this year, it tempered expectations for future rate cuts. And that's the thing most people were really excited about was cut rates. I want, 3% mortgages for 30 years. That's great if you can get them, but that's just not realistic in the big picture. Where was I? The 2-year Treasury yield, which is particularly sensitive to interest rate decisions, closed at a new 52-week high of 5.120. And I think the other day on the overnights, it was up at like 5.3%. It was really jumping. I think that was Monday. This surge in yields put pressure on growth sectors in the market, with big tech companies like Alphabet, Meta, and Apple experiencing declines, with Alphabet falling more than 2%. Instacart, the online grocery delivery platform, faced challenges post-IPO as its stock fell over 10%. Just above its IPO price of $30. The company had made its debut on the market the previous day, initially surging as much as 40% during the initial trading, but ended the day with a 12% increase. This decline followed Needham analysts in initiation of coverage on the stock with a hold rating, citing increasing competition and a slowdown in online grocery sales as contributing factors. I mean, do people really use those? I mean, I live out in the middle of nowhere, so I got to drive a half hour to the grocery store. But I mean, do people really use that service? I mean, I don't know if I want somebody picking out my apples or potatoes or stuff like, steaks. I mean, yeah, sure. If it's like a can of, chicken soup, I mean, they're all the same. But, when you're picking out like fresh cuts of things, anyways. In summary, the S&P 500 retreated amid rising Treasury yields, especially impacting the tech sector after the Federal Reserve's decision to keep interest rates steady while signaling a commitment for higher rates. Additionally, Instacart's stock faced challenges shortly after its IPO, with concerns about competition and a slowdown in online grocery sales affecting its performance. All right, so that's that. Let's jump into an article from Zero Hedge titled FOMC Leaves Rates Unchanged, Signals Much More Hawkish 2024. All right. In the latest Federal Reserve decision, interest rates were held steady within the target range of 5.25 to 5.5, which stands at a 22-year high. 22 years ago seems rather short now that I'm almost 50. When I was 22 seemed like forever. However, the central bank adopted a more hawkish stance on future rate increases while signaling confidence in achieving a soft landing, that's in quotes, while higher growth forecasts, or with higher growth forecasts. The dot plot of rate projections indicated that policymakers foresee one more rate hike this year, but projections for rates in 24 and 25 were each raised by a 0.5 percentage point. This suggests that the Fed expects interest rates to remain elevated for a longer duration. Out of the 19 policymakers on the FOMC, 12 anticipate one or more rate hike this year, while the remaining 7 favor maintaining rates at their current level. The median projection for economic growth in 23 saw a significant increase to 2.1%, up from the 1% forecasted in June. Additionally, unemployment forecasts were lowered, with officials now expecting a jobless rate to peak at 4.1% instead of the previously estimated 4.5%. And if you recall, we covered an article, maybe have been yesterday, but I think Monday, that was talking, or yeah, it was Monday. It was the video that I showed, and the gentleman that was talking about basically reviewing a bunch of analysts, and they foresee that unemployment could be as high as 5%. So we shall see. While the Fed acknowledged that job gains have slowed, they emphasized that the gains still remain strong. However, the announcement had notable changes in rate projections. For 23, 5.625 versus the previous and expected 5.625. 24, 5.125 versus the previous 4.625 and expected 4.875. And in 2025, 3.875 versus the previous 3.375. So that goes up by about 0.5% and expected to be around 3.875. So what we're seeing here is that in 2 years from now, they expect that the average rate for that year will be about 3.3 to 3.4%, which is almost double the inflation rate at their goal of 2. So 2 years from now, they're still going to be twice as high in inflation. I mean, anyways, the central bank's long-run rate projection was at 2.5%, unchanged from the previous value, but slightly lower than expectations of 2.625%. While the Fed's decision was expected to leave rates unchanged, its more hawkish stance, as evident in the dot plot, suggests a more aggressive approach to addressing inflation. The shift in policy comes amid tightening financial conditions and a changing economic outlook. In conclusion, the Federal Reserve chose not to adjust rates, but provided a more hawkish outlook, raising projections for future rates and while expressing confidence in the economy's growth prospects. This decision reflects the central bank's determination to address inflation and maintain economic stability. Yeah, they're doing a great job, right? Anyways. All right, one more article here from Mises Wire. It has to do with the UAW strike. Strikes always have economic consequences, and the latest UAW strike is no exception. This was written by John Kennedy. And let's go ahead and jump into my notes here and see what he had to say. The United Auto Workers Union launched a massive strike involving 13,000 workers, simultaneously targeting three major automotive companies, General Motors, Ford, and Stellantis, on September 15th, 23. The strike affected three assembly plants, a General Motors factory in Wentzville, Missouri, a Ford plant in Wayne, Michigan, and a Jeep factory owned by Stellantis in Toledo. The primary demands of the UAW, as articulated by its president, Shawn Fain, include a 36% pay raise over 4 years for its members. Wow. Just to build cars. I mean, they don't even build cars. They just assemble them. So you're not car builders. You put Lincoln Logs together and you expect to make $100 an hour. A 32-hour, where were we? Over a 36% pay raise and into varying tiers of wages for factory jobs. Well, everyone should just get the same thing. I mean, your more productive workers should get better pay and your least productive workers should get the least pay or fired. I mean, these people think that business is like some fairy tale. I mean, come on, people. A 32-hour work week with 40 hours of pay. That makes sense. I mean, if I was running that business, I'd be like, sure, have a free 8 hours. The reinstatement of traditional defined benefit pensions for new hires who currently receive only 401k style retirement plans. Boo-hoo. Yeah, your pension's never coming back. And a return of cost of living pay raises, among other benefits. While these demands might seem justified to some, not me, there are concerns about the potential economic consequences if they are met in full. Historically, unions have been a contentious issue, with critics arguing that they can negatively impact both industries that they represent and the broader economy and the people. The example of John L. Lewis, the president of the United Mine Workers of America, is cited as a cautionary tale. Lewis advocated for higher wages and benefits for miners, but didn't fully consider the economic repercussions of his actions. Strikes and resulting wage increases led to coal becoming less competitive compared to oil, ultimately reducing employment in the mining industry. Smart. Private sector unions differ from public sector unions in that they can't rely on taxpayer money. They must ensure the business they operate within remain viable, or their members risk losing their jobs. When unions negotiate for wages and benefits above market rates, it can lead to reduced employment as businesses struggle to remain profitable. The UAW contention that Ford CEO Jim Farley makes too much money is also discussed. Critics argue that Ford's salaries are determined by market forces, with companies needing to attract top talent to succeed. Unlike unions, which collect dues and funds that don't contribute directly to productivity, company profits and CEO salaries are typically reinvested in capital and technology, making workers more productive and valuable. In summary, labor unions like the UAW have been the subject of debate regarding their impact on wages and the economy. Critics argue that their demands can have unintended consequences, including reduced employment and potential harm to the companies they represent. The role of market forces in determining CEO salaries is also highlighted as the key differences between unions and private sector compensation. And if I was running Ford, what I would be telling them is you are going to lose 5% of your pay every day you do not show up. And after 20 days, you're fired. It's that simple. You don't want to work? Get the hell out. These lazy bastards. I mean, come on. Anyways. All right. Well, that's everything I had for today. And if you have any problems with what I had to say, eat a dick. If you need any help with your finances, feel free to go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.